Hey everyone, and welcome to This Explainer. Today, we're distilling 20 incredibly powerful lessons that truly separate the average investor from the genuinely wealthy. We're going to break down the fundamental mechanics of dividend wealth construction. So if you've ever felt like the stock market is just a rigged game, well, you're in exactly the right place. So what if I told you that most investors don't actually lose money because they failed to pick the next Nvidia, Tesla, or Apple? I know, it sounds kind of crazy, right? But investor behavior studies reveal that the average investor consistently underperforms the broader market by several percentage points every single year. They aren't missing out because they lack some magical market foresight. No, they're losing out because of entirely preventable, mechanical mistakes. To make this all super actionable, we've organized these 20 golden rules into 4 main pillars: the great illusion, portfolio pitfalls, the psychology of wealth, and finally, the ultimate heavy lifter. Let's just dive right in. All right, kicking things off with Section 1, the great illusion, exposing the silent money mistake. Okay, here's a massive eye-opener for you. That whole prevailing myth that you need to be some sort of Wall Street stock-picking genius to get rich? Complete fiction. The reality is that wealth is lost through bad decisions and terrible timing. It's about doing the wrong things at exactly the wrong time. If you just eliminate these unforced errors, you instantly elevate your long-term returns. It's really that simple. Instead, meet the real culprits here. We're talking fear, bad timing, tax mistakes, emotional decisions, and just plain portfolio clutter. These are the silent wealth destroyers that are quietly costing investors thousands, sometimes even hundreds of thousands of dollars over a lifetime. It's absolutely vital to recognize these behavioral traps before you even think about hitting that buy button on your brokerage app. Moving right along to Section 2, Portfolio Pitfalls. Let's fix those mechanical errors. Listen, before you even attempt to build out an aggressive dividend portfolio, you've got to follow this exact order of operations. Step 1, get that cash safety net dialed in. Without it, a sudden market crash is going to force you to sell your investments at literally the worst possible moment. Step 2, secure that employer match. Honestly, it's mind-boggling that anyone leaves this behind. It is free money, plain and simple, and one of the only guaranteed returns you're ever going to see. Only after all that is sorted do you move to Step 3 and actually invest for growth. Now, this is a remarkably common trap. Buying 5 different dividend ETFs and proudly thinking, hey, I'm diversified. But if you look under the hood, you often own the exact same companies over and over again. It's just portfolio clutter giving you this false sense of security. True diversification? That means looking globally, protecting yourself from one specific country's economic shifts, and using smart strategic asset location. You also really need to internalize that growth investments and income investments are completely different tools. Think of growth as playing the long game. It focuses on capturing huge capital appreciation over decades of your life. On the flip side, income or defensive investments are built for stability. They're designed to provide that reliable cash flow when you actually need to live off your portfolio right now. Which brings us to an absolute lifesaver of a concept: total return. Look, chasing a sky-high dividend yield is a really dangerous trap if the underlying asset is just bleeding its core value year after year. The income you get is never going to compensate for those catastrophic capital losses. You must, absolutely must, evaluate an investment by its total return. And, so many investors learn the hard way that supposedly safe assets, well, they can actually experience massive losses too. Mistakenly treating bond funds exactly like cash, yeah, that's going to lead to a pretty unpleasant shock when you open your statement and see your safe money has suddenly dropped just because interest rates shifted. Cash is for extreme safety and liquidity. Bond funds carry a completely different risk profile. Please don't confuse the two. Finally, for this section, let's talk about the silent partner in your portfolio: taxes. A brilliant investment sitting in the wrong account becomes incredibly inefficient. Not all dividends are taxed equally, which makes smart tax planning and tax-free growth accounts some of the most potent wealth-building secrets out there. Because remember, it's not just about what you earn. It is 100% about what you keep. That brings us to Section 3, the psychology of wealth, mastering investor behavior. If you want to survive market turbulence, you absolutely need behavioral mastery. That means resisting the urge to check your portfolio every single day. Seriously, maybe just look at it yearly instead. It means fighting lifestyle inflation tooth and nail. When you get a raise, invest it instead of immediately upgrading your car. Accept that market crashes are just totally normal, and remember that steady consistency will always beat waiting on the sidelines for a perfect entry point. Because history proves time and time again that the biggest investing mistake isn't buying at the peak. Now, the fatal era is panic selling during the downturn. You're just locking in your losses and completely missing out on those powerful recovery periods that inevitably follow. And this psychological fortitude, it becomes incredibly serious during the very first years of retirement. We call this sequence of returns risk. Basically, if the market crashes right as you start withdrawing your funds, it can severely devastate how long your portfolio lasts. Having a concrete strategy and a stable cash buffer for these downturns isn't just nice in theory. It can literally make or break your entire retirement. All right, let's bring it all home with Section 4, the ultimate heavy lifter, the magic of compounding. Here's the stark truth that so many folks discover way too late. The wealthiest investors out there don't have a crystal ball. They can't predict every market move. They simply start early, they actively avoid the unforced errors we just outlined, and then they just step out of the way and let compounding do the heavy lifting. Time is, without a doubt, your greatest asset. I really want this core lesson to sink in. Small decisions repeated consistently over decades often outperform brilliant decisions made occasionally. That right there perfectly encapsulates the most important investing principle you will ever learn. You don't need random strokes of genius. You just need unbreaking consistency. Ultimately, the stark difference between a life of deep financial stress and a life of total financial freedom comes down to just these three super simple habits. Start early, stay invested, and ignore the noise. So you now know the mechanics, you know the psychology, and you know the silent wealth-destroying mistakes to avoid. So the final question you've got to ask yourself today is this. Are you ready to step away from the daily noise and let compounding work its magic, or are you going to let another year of growth just slip through your fingers?